Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. We've enjoyed a very large credit boom that's sent us soaring to new heights in the stock market, but Bob's dug up some information that's going to show you that maybe that isn't going to continue. And so you're going to want to see the data he presents here because it's going to be important to your financial future. So stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, how's it going? Yeah, interesting data you dug up here as far as credit cycles. Can you enlighten us a little bit on that?
Yeah, Phil, how's it with you? Good?
Yeah, all good.
Good. So, what's interesting is they have the world stuck in a basically a narrative driven environment where you don't know there was a past and you don't know where there's a future. You're just kind of stuck in the now. And what we want to do here today is we want to connect some dots for you, because what you see today and how it feels today has nothing to do what tomorrow is going to bring. And so the first chart I think you want to show us is it the credit one?
Credit boom?
Yeah, take a look at this chart, guys. This is, and it was really interesting. I was reading an article this morning. We just didn't want to pepper you with graphs and slides here, but the essential nature of it is that you can't have credit booms and credit collapses without the Federal Reserve. And it's because the nature of the fractional reserve lending they do. So in the economy, there is so much cash and there's so much productivity. And if that's all you had and the banks had to lend out what they had in their vaults, you can't crash, you can't boom. You're just going to grow with population, money supply, and productivity. But with the advent of fractional reserve lending and taking it to the extreme nature, you get these booms and basically, interest debt, Phil, as you know, it's geometric in function, okay, because the debt builds on debt, but people's incomes aren't geometric. And so at some point, debt can't be serviced and you get these crashes that basically just unwinds things again back down to the growth in the money supply. And we're now at a point where they came out of 2008. I mean, like, these guys were so scared. They were running like a scalded dog, Phil, and they just threw all kinds of money at every problem. And then, we got into 2020 and they threw more money at this, and they threw it in terms of debt. And you got this move here where this is the most credit created in the history of humanity. And these things just don't unwind, they collapse. And I just want to get your thoughts on that too. I mean, it looks pretty unsustainable to me. How about you?
Well, yeah, I mean, this chart is, just by the nature of the chart and how steep the rally is, I mean, these angles don't sustain. And you can see a few times in there where we've had some pretty good downdrafts going into the end of 2018 and obviously COVID, but they had fairly quick recoveries only because the Fed was stepping in and not necessarily tightening like they're doing now, which actually brings us to the left side of that chart, which is credit contraction. And that's what we're entering now, because as the Fed tightens, so does credit. And I think you can see that in that bank chart that we're going to show here in a little bit.
Yeah. And, one thing, bear in mind, like, one of my jobs I had in my corporate life was buying companies on behalf of my corporation. And we used to always laugh because people always talk about, income and assets and they're well collateralized. But the dirty little secret is that assets are ephemeral. Income is ephemeral, but debt is real. And so what happens is that once you can't sustain this stuff, it starts to roll over. And I think the thing we're seeing now is the banks are a little bit smarter this time. They pushed all the risk onto you and onto the government this time, and they bailed out. And look, what they're doing now is this next chart is showing you they're basically raising their lending standards. Basically, they're turning off the spigot, and they're relying now on basically, you got shadow banking, you got the income from government stimulus checks and programs. But the banks are walking away because the banks know what's coming. They have risk managers all day long telling them, don't lend any more money because the end is nigh. And look where that thing hit. Where we are now is the same place where it always rolls over and turns into recession, Phil.
Yeah. I don't know how many times we can look at a graph in the last 3 weeks now, and every single one is pointing to recession. I mean, it's just becoming, it's inescapable at this point. It's actually, I don't know how else you can get down to these levels across all these metrics and not have a recession at this point. It's just a matter of how many months are these data points leading the actual recession. And we have an important GDP Q over Q data point coming out later this week.
Yeah, I mean, I feel like a guy sitting on top of the cliff of the shore and have people out there, picking seashells up because the tide went really far out,
Yeah. Yep.
And they're like, man, look at this. This is great. And then, if they would just lift their head up a little bit, they see the wall of water coming at them. And, and I feel like you and I we're both pretty optimistic people by nature, and we're always looking for opportunities. But, what's happening here is that, it's time to scream. And people are thinking now, we went from hard landing to soft landing. And now people are talking about this no landing thing. And I just want to disabuse people the notion that no landing is a good thing. It means that you may not see nominal recession, but you're going to not be able to afford anything. It's just you're just going to be on a ride that you can't get off, and so they have you trapped, and they're trapped. And this next slide, I think, just pretty much sums it all up.
Yeah, and I think this plays into where we saw a really hot retail number come in last week, which people point to as, oh, the economy's strong, we're not going into a recession. But it's like people are now dipping harder into their savings and racking up credit card debt. And so I think that's the key difference when you look at that retail number versus other impressive retail numbers in years past.
Yeah, and Phil, I should have put this chart up for us. 19% of all retailers intend to retrench significantly next year in terms of employment. And you don't get rid of people in retail, unless you think you're going to be closing stores, closing hours, simplifying your business, or, some smaller cases, continue the automation train, to get rid of, employees where you can through cashless registers and inventory management. But, you don't get rid of, hundreds of thousands of people in retail unless you don't think you're gonna sell to them, or they're gonna sell to you, I should say.
Right.
So yeah, I think we're on the brink, and what's really weird is this whole thing is people talk about the K economy, and I don't know if anybody's ever heard that phrase. It means that the bottom 90% are going to suffer greatly, and the top 10% are going to not. They're going to barely notice what's going on. And we're seeing it now, like luxury hotels, luxury vacations, high-end areas are all acting like it's 1929 before the crash, but everybody else is sucking wind. And I think, we're going to get to the point where that whole band breaks. And when that breaks, then all hell's going to break loose.
Yep, I agree. All right, guys. Well, thanks for tuning in on this episode. We hope that's helpful. Let us know your thoughts on where you think we are in terms of the economy and what your situation is as far as employment. We'd love to hear some different views on what your situations are out there. So once again, thank you for watching. Please hit like and subscribe, and please hit that notification bell. Set notifications to all if you can. That'll really help us out with the YouTube algorithm and help us keep giving you this content. All right, guys. Thanks for watching. Bye.
Trade Genius.